Tony, do you want to do the introductions to John and the interview?
Yeah, sure. So I mentioned on our show a little while ago that I've become a director of Clime Investment Wealth, and we have my boss on today for the interview, John Abernethy, who has been around in investment circles publicly in Australia for how long, John? 30 years? Something like that?
40, over
40. There
40.
you go. I'm underselling you. So
Mm.
I thought we'd get you on to talk to our listeners and pull back the curtain a little bit on Climb and on the funds management industry in general from the other side. We talk about
Yeah.
investing a lot and valuing companies, etc. But it's I think it's great to find out what goes on from the business side of the funds management industry. So maybe you could start off and tell us a little bit about yourself and your background and how you got involved and where you come from.
Well, it's everyone's story is chaos, I think, when you start. And I qualified in law and economics, came out in a recession in 82, 83 in Australia when there was not many jobs around, found myself in Westpac Bank as a trainee, went through the branches and into head office, and then was more interested in probably macroeconomics and investing. I guess I was looking at investing, but didn't really know what I was talking about. There was an opportunity inside Westpac at the time for someone like me. I applied for a job as a trainee analyst at NRMA, got the job, and then stayed there for 10, 11 years and ended up as the equity manager and investment manager for the group, NRMA group. And we achieved various awards. I think one year we were the fund manager of the year, I think 92. From there, I left when NRMA demutualised and went into corporate advice and early stage investing, venture capital. Created a company which was called Loftus, floated on the stock market at the just about a month before the internet bubble crashed. We had a few early stage investments in internet businesses, which were difficult workouts. In about 2004, we got rid of our PDF, where we were a venture capitalist under a PDF Act. We deregistered that, went to an open investment company, and we bought a business called Clime, became Clime Investment Management in 2005. And today that's 20 years later, we're about $1.6 billion under management and advice. So we've gone from being a pure equity manager to a multi-asset manager and high net worth advisor, essentially what we are today.
I'm always fascinated to talk to people from the insurance industry who are involved on the investment side and would love to
Mm.
understand the concept of float that we hear so
Yeah.
much about when we read about Berkshire Hathaway and listen to Warren Buffett. So
Mm.
was that an important issue for you at NRMA? Was it trying to manage the float or is there a different
Absolutely.
legal framework in Australia compared to the US?
Well, it's a good question because the NRMA Investments was directed to run as a Buffett type investment group, and the NRMA investment portfolio at the time essentially was managing 80% of the reserves of the NRMA insurance group. As it was a mutual, it didn't pay dividends. So there's your comparison to Berkshire Hathaway. Berkshire Hathaway doesn't pay dividends. NRMA as a mutual didn't pay dividends. It grew its reserves. And the direction was 80% of the reserves into the equity market of Australia. And that was a very open mandate. It could be unlisted and listed at the time. So NRMA was one of the first direct investors in the country. And we built up a pretty sizable unlisted book, direct book. We had external managers at one time, but then we brought it in-house. But the investment focus was on just buying good companies, not looking at the index, targeting a compound return of around 8%. The management of NRMA Insurance said if you can compound at 8% over 10 years, that alone will increase our reserves by about 150% over that period. And that's before we get flows, which is the insurance margin. And NRMA was run by very skilled risk managers. And I think we were renowned for that in the 1980s. And I'd point out someone like John Lamble, who ran NRMA Group. He was the executive CEO, and I think he was regarded as the best insurer in Australia at the time. And our chairman of the NRMA Group was Jim Milner, of Brickworks fame. So we had blue blood in our company.
Yeah, very much so. Was there a slant towards value investing then, or was it more general?
No, that was value. I mean, I used to get, or John Lamble used to send me and the whole NRMA investment department the yearly address from Warren Buffett. He'd actually walk it into our office and say, please read, please read by the best in the world. And he said, just follow that. And he was adamant, and it was drilled into me, common sense investing. And not be afraid, pick out good stocks, small, medium, large. He was a great believer in companies which could self-fund growth, and he said you'll get the best growth in the middle of the market if you pick the right stocks. And you've got to remember, in the 80s, that the Australian share market was much broader than it is today, across industries and sectors. I mean, it's a very different market today than it was in the 80s. And because it was so broad, and we just opened up the economy to foreign investment, foreign banks, there was a plethora of corporate activity. And obviously the biggest corporate activity in the 80s was the bid for BHP by Holmes at Court, which NRMA, like other institutions, were big holders in BHP, and so we were right in the middle of that. And then we had counterplays with a lot of industrial companies, investment groups like Adsteam, IEL, Elders, all playing in that space. It was a great time for investing, and we were quite an active investor. We had a core portfolio which was capital gains restricted because we didn't want to upset our capital gains position, but outside that we did have some books where we could move portfolios around and be liable for tax. So it was a big business. I mean, my recollections when I left, the assets of NRMA Group was about 7 billion, and we had about 2 billion in equities. And the reserves were about 2.5 billion at the time. So, and that's 1990 prices. So that's a long time ago. So you can maybe magnify that by 20 or 30 to get to an equivalent of today.
And I think from discussing this with you in the past, there was some convertible notes involved. Could you outline that for our listeners? What they are and what role they play in helping the portfolio?
Well, again, John Lamble, he and Sam Kaplan was my direct equity manager. Sam taught me that very much as an investor, we're looking for cash flow to us as an owner. Now, having said that, we did make some longer term investments expecting cash flow to appear, or committing to companies. Like we were a very early investor in Macquarie Bank when it was unlisted. And we're one of the major shareholders when it listed, but I think for at least a decade, all dividends declared by Macquarie Bank were reinvested. So that was a compound going inside Macquarie Bank, which became a wonderful investment. But when we found other companies, and I guess it's something I drove, very often there was a discussion with companies, middle-sized or smaller companies, and we were open book, who wanted to raise capital, and they were coming to us directly. Brokers were there. When it was a decent size, there was a broker, but when there wasn't, it was direct to us. And very often it was a discussion about value. And as you know, when you're raising capital, you want the best possible price. When you're investing capital, you want a lower price with a return which you can see coming from that entry point. And very often we closed the gap through what we said was a convertible note. We did this to great effect in the late 80s, early 90s, and I took that into my venture capital days or development capital days by, bridging the gap between what a company wanted to issue capital at and what I wanted to invest at. And I often said, well, look, just think of an example. I think you're worth $1. You say you're worth $1.50. I'm not going to pay $1.50, but I'll tell you what, I'll pay $1.30, but here's my conditions. It's 3 years. It's a convertible debt. So I'll give you the $1.30. If you perform and your equity value goes way above 130, then I'll convert it. If you don't perform, I'll get my $1.30 back. And in the meantime, you're paying me 8 to 10% per annum income. Okay, so I'm getting my targeted cash flow return, and I'm looking for outperformance by the company achieving what it said it was going to achieve in its forecast valuation. And that's how we use those over and over again. And we even took those structures into converting preference shares sometimes. And we went into the unlisted market where you had to protect yourself because there was no liquidity. So we often did convertible notes too, which come to mind. We did a big investment in United Milk Tasmania, which was a mutual, had non-voting stock, but we took a convertible pref. And then we did other investments. Never Fail was one. Peters and Brown's Foods, which someone might have heard of, that they brought Connoisseur to Australia. We did a big convertible note, and my recollection was 8 or 10% yield, and we had to roll it once because there was difficulty in the company, and we didn't want to own the company. We wanted to convert or be redeemed, and we gave them 2 years honeymoon, and that company began to fly. It was a Western Australian dairy company of all things, but a agricultural company, couldn't get capital from the Australian market, had run out of bank facilities, and we came in as virtually a bridging financier with convertibility. So they're notes which can protect you. And my only final comment, Tony, is that's exactly what Buffett did in 2007. When there was catastrophe in the GFC, he did those convertible debt or debt with attached warrant in companies like GE and Goldman Sachs, for instance. I think Bank of America or Wells Fargo, he did quite a few of these. And I'm not being smart, but that's exactly what we did 20 years earlier in NRMA Group, based on the way Buffett wrote how you should invest.
No, I was going to mention that, so thanks for reminding me. And then after NRMA, you moved into Loftus, which then went into Clime. And I know the answer to this question, but can you tell us what Clime actually stands for?
Well, it's Clever Investment Made Easy. Clime as a word doesn't exist, so it's an acronym, I guess. So that's what it stands for. And the cleverness, I think, is in the value investing methodology, which that company, when it was managed by previous owners, was driving into value-based investing based on return on equity and identifying companies' intrinsic value based on the size of the equity and the return on equity and the capacity to grow the equity through retained cash flows, so self-funding growth. And finding those companies and taking stakes in them, much better to buy a business which can self-fund growth than a company which draws on capital to grow from the external world. And it doesn't mean that companies which raise capital are bad investments. It just means that companies which can self-generate capital are the best investments. And we have an investment, Tony, inside the Clime Investment Group, shareholders who own Clime Investment. When we converted from a PDF to an unrestricted company, we had one major investment from our venture capital, development capital days, a company called Jasco. And that was an investment which Loftus made in 1995. So it's a 30-year investment. Today, that investment sits in a company called Clime Private, which Clime shareholders received in 2016. The history of that company is we put $750,000 into Jasco as a 10% pref, 3-year pref, converting pref. It paid us the 10% and we converted into about 20% of Jasco when we converted. That $750,000 today is worth circa $13 million at book value. And it's paid us a dividend every quarter for the last 30 years. We've never put our hand in our pocket to put more money in. And it's returned us at various stages capital returns of about $5 to $6 million. So they're the sort of great investments you're looking for. Very hard to find. There's a few on the stock market. The stock market's open for business every day, and there are companies which you can identify which are self-funding growers. And one I've always looked at was Nick Scali. Its first capital raising, as we know, was last year when it went into England. But up until that stage, the company just grew by self-funding its growth. It was one of the better examples of self-funding growth. So they're few and far between, but when you find them, they're extraordinary generators of value for owners.
And you've spoken about Jasco, but people might know that Jasco owns the Eckersley art stores. business. So that's the sort of
Yeah.
public face of Jasco. Yeah. Yeah. One of the things we
And
focus on in our, sorry, you go.
no, I was just going to say it's a great little business, but obviously something we can't talk about because it's trading on a grey market at present. Anyway.
Yeah. Something we talk about a lot in our checklist is consistently increasing equity. So that sounds similar to what you're talking about in terms of a company being able to fund its growth. Very important things.
Yeah. Yeah. Look, where I'm a little bit different from Buffett, just to cover it, I like dividends as an owner. There's a great debate. Buffett would say, well, if I can do better with the money, why would I give it back to you? And that's fine. And so long as his great benefit is he has enough of a market, a deep enough market where the owners of Berkshire Hathaway can get value for their stock in the stock market. Now, if you're a small company in Australia and you take that view, well, I'm going to keep the capital and grow, and you run the risk that the value of your stock, if it's trading on the stock market, does not reflect its true value, because there's always people who want to sell, and they don't, when someone wants to sell, they lose sight of value. And we find some of these companies get sold down and trade very cheaply. And it's not fair to a shareholder who is going the journey to have his shares trading well below value. Now, other people say, well, that's an opportunity for someone to buy more. But, you're trying to look after your owners, and particularly your long-term owners. So it's a moot point. I'd like value investing where companies pay dividends and give the owner, the recipient of the dividend, the right to reinvest. Not necessarily through a DRP, but he's got the money, then he can make a decision where he wants to buy more shares. I think that's and that allows, you look at something like Nick Scali, which has gone through patches where the market has disliked it. It's been a great opportunity to buy. I used to do presentations a bit like you do, Tony, on value investing. I always used to talk about Nick Scali and through 5-year financial models, and I could show the audience how Nick Scali would grow, without drawing on new capital. It just drew upon the generated capital from the business. And I used to do this presentation, turn off the screen, turn off the market for 5 years, don't look at the share price, here's the 5-year returns, are you happy as an owner? And everyone said, fantastic. Then I turn on the share market and Nick Scali's gone from $4 to $6, back to $4, to $5, to $3, to $8. That's during the 5 years when it never missed a beat. And we've got to be careful, and that's the opportunity as someone who's looking for value, is the share market prices itself on some of the most weirdest basis day to day. And people looking at share prices thinking that I'm not saying they don't indicate trouble or indicate good news sometimes, but often they indicate nothing rather than, mad speculative trading.
Yeah, it's always amazed me that they still teach efficient market theory in universities, when that's a classic example of how the market is inefficient.
Well, I remember giving a presentation. I mentor students from New South Wales Uni, but not about investing. But I remember I was called to Sydney Uni one day to give a presentation, and the guy was running a trading course. I don't know his name, can't remember it. And he was teaching stop loss selling. And I was asked a question by one of his students, and I said, what do you think about stop loss selling? I said, it's totally appropriate if you don't know what you own. If you buy something you don't know what it's worth, then having a stop loss is appropriate. But if you know what something's worth, having a stop loss doesn't make much sense, if you know what I mean. So, when we talk theory, or we learn theory at uni, very often it's based on naivety, and I'm not being rude, I just think that's the theory. So, the market's always right, fair market theory, stop losses, they're just interesting. But I think when you get into the real world and understand the real dynamics of investing, you can see the flaw in a lot of that.
Yeah, it's a very good point. I wanted to touch on the industry itself as well. So rather than pushing on with value investing, which is fascinating in itself, but Clime is in the fund management game. Can you talk about it from the industry side of things? What kind of trends are you seeing in the funds management industry in Australia now?
Well, when you talk funds management, I think today you're talking multi-assets clearly. And one of the things we did in Clime 10 years ago was go from being an Australian equity manager to a multi-asset manager. So what I would call a true funds management business. And that took me back to the days at NRMA. When we managed portfolios, we were managing, bonds, bank bills, short-term money market, leases, finance leases, then into equities, and as I said, convertible debt finance. So the multi-assets in those days, as you would hear from that, I didn't talk about international, so that was in the 80s. Today, a multi-asset manager, a true funds manager, is looking across a whole lot of asset classes, inside Australia and outside Australia, equities and bonds, credit, property is another asset class developing. So Clime has developed that expertise either in-house or externally, so external partners. We're building up our funds management team so we can hit those multi-markets with solutions for our clients. And I think that's also reflecting what's happened in the broader market.
What was driving the trend to multi-asset though? Why not stay just as an equities company?
Oh, look, the size of funds, Tony. I mean, Australia's went from where it was to now $4.25 trillion in super. And the Australian economy went from where it was probably about $1 trillion economy to a $2.8 trillion economy, and the stock market did a similar sort of ratio. So you can see that the investable capital through superannuation was growing a lot faster than the Australian economy, which means that if you were equity centric, you had to extend yourself and acknowledge that there are multiple opportunities. And if you go back to 2014, one of the reasons where we pushed heavily into multi-asset, it was a time when the Australian dollar was above parity against the US dollar. So it was trading, 30% above its long-term average since it floated. It was arguable, and we got it right, that the Australian dollar was overvalued. So there was an opportunity to diversify into international markets and pick up on the devaluation of the Australian dollar. And that took us into and also away from other asset classes. A devalued Australian dollar would open up the opportunity for foreigners to start buying hard assets or fixed assets apart from the equity market. So property came into play, and fixed income came into play. And Australia's property market went much stronger, its commercial property market. After we had that devaluation, then the property market probably from about 2016, 17, probably had 3 or 4 years of great returns as foreign entities and institutions said, well, there's an Australian dollars now at fair value and the yields are pretty darn good compared to what we're seeing in our own market. And the quality of the Australian economy, the balance sheet of the Australian economy, the legal system, the accounting system, big ticks, we're buyers. And so moving to a multi-asset before the foreigners came in, that was just an opportunity we saw. Now that's the past, and we're into a different era now where, we're into the Trump era. We're into an era where the whole funds management industry of Australia has expanded to extraordinary levels, and there are much different problems to address today in terms of investing. And meanwhile, I did mention earlier that the Australian market in the 80s and early 90s was a very diverse market. Today, it's not so diverse. So you've got more money to invest in a market which is tighter in terms of bandwidth, industry sectors, that's thrown up issues for particularly equity managers, pushes them to think about other asset classes, pushes them to think about other economies.
One of the things I think has also happened recently, which you could elaborate on, is the rise of managed investment accounts. And I know Clime's involved in that. Can you give us an outline for our listeners as to what they are and how they operate?
Yeah, well, our history was free products. We obviously have Clime Capital as an LIC, managed investment funds, unit trusts, particularly going into and coming out of the GFC. And then for higher net worth clients, what we called individually managed accounts. And those IMAs were very much Australian equity centric. We could have taken them into international equities, but it was very much the IMA was an equity asset class solution. What's developed is the extension of the IMA into, what they call SMAs, where you can do multi-asset solutions. Now, MDAs, SMAs, IMAs, they're all a connotation of the same thing. The difference is the SMA is multi-asset and probably for smaller size clients where the manager can move investments around and does it for multiple clients at the same time. So it's more a multi-client, multi-asset solution where the manager is making those decisions daily to adjust. Okay, it doesn't have to go to the client. And the solutions may not only be direct stocks, but they could be managed funds or direct property. So that's that. The MDA is a more tighter relationship, very much equity centric, but can also go into other asset classes, and it's more individually set to the client directive. So they're bigger type clients. So that's your managed direct asset portfolio as opposed to a separately managed asset portfolio. And then, of course, we've still got the IMA, which is equity centric. Then outside you've got your managed funds, again, which is the thing about the difference between a managed fund and an SMA. The SMA is in the client's name. So all the benefits of income, franking credits, tax losses if they occur, capital gains, goes directly to the SMA owner. In a managed fund, it's shared. And the benefits are more shared at the end of the year. So if you're being an investor at the end of the year, you can get a benefit which you didn't get if you left the managed fund before the end of the year or during the end of the year. And, the managed fund trades at NTA and gives people the opportunity to buy and sell it. So it's a much different concept, much more difficult to manage. And I think the advice world has realised that managed funds, unless they've got an overlay and it's controlled through an SMA product where the manager is deciding the allocation to managed funds, not done directly by the investor. And as I said earlier, in an answer about equity market, you get very strange equity prices going on all the time. Investors can be spooked and can be liquidating a managed fund at the worst possible time. But what we saw in the GFC, managed funds being hit with withdrawals, and the fund manager was forced to sell when he wanted to buy. And this played out in Clime when we had our investment company, Clime Capital, which is a sort of a permanent capital multi-asset solution, but at the time it was very equity-centric. Well, we had permanent capital. People could sell their Clime shares on the market, but it didn't affect our capital. And what we'd done during the GFC is raise cash, and we started directing investments into discounted convertible notes and convertible prefs, and that became a wonderful return for us. Now, if we'd been an open-ended fund or, a management agreement where the client could withdraw money, you couldn't actually manage the money appropriately for the client because they wanted their cash. Even if they were taking $1 investment and, look, we're just happy at 50 cents, we'll just take the 50 cents, So it causes a bit of chaos. So structure is important, I think is what I'm getting to. So when a client comes to us, we talk to them about structure. How much influence do they want to have? How much do they want to see? Do they want us to run the multi-asset solution across the asset classes? Do they just want to be in equities? That's the discussion we have with our advisors.
And I think, so from the customer point of view, they would come and talk to an advisor. They would then open an account which would be listed on a platform. So could you just explain how that platform process works too? Thanks.
Yeah, it's a bit like a bank account, isn't it? We've got all these platforms, and when I was in my early days, it wasn't such a thing. It was we just held all the script ourselves at NRMA. We had bucket loads of script, and settlement was 5 days in those days. It was quite amazing. Today, it's all like a platform, as you say, an administration service where third parties, most of them are listed companies now, which is good. So very transparent with capital and licensed and registered. And their job is to hold the assets on behalf of the client. So they're third party away from the fund manager. That's a good solution. Fund managers and administrators probably shouldn't be in the same entity. We've had issues about that in the past. So that's a third party service. And those administration platforms have gone from pure equities now into a whole lot of multiple asset classes, allowing the advisor for a client or the client directly to buy and sell through the platform and access products across asset classes and build their own multi-asset portfolio alone or as advised. So it really is a custodian service, a settlement service, all wrapped up in one.
Yeah, it's very flexible too, isn't it? So if I
Yeah.
came along and said I like value investing, I could open up an account. There could be some advice around that. I could do some of it myself, and it would be managed
Yeah.
on a Hub24 or Praemium or someone like that.
Yeah.
And I don't have to put it into a super fund or an industry super fund or anything like that. I can somewhat do it myself.
Yeah. Yeah. Or you can use your super fund and put
Yeah.
it into a platform service. So there's lots of opportunity now, much different to what it was 20, 30 years ago. So it is very user friendly. And I think, as we're seeing with the headlines today, it's very much about trust. And it's disappointing in an industry of $4 trillion or more when you add private investments, when we do get bad behavior by some financial institutions and entities who promote funds which are not fit for purpose. And it's disappointing. And what we do at Clime, we're very transparent. We're a public company, and you know who you're dealing with. I guess you know me, if you've followed me for a long time. We've got a balance sheet, we report to the stock market, we're licensed, we've got an AFSL, we've got qualified advisors, we've got a balance sheet, we co-invest with our clients. So that's the sort of entity I think you want to deal with, rather than these obscure private entities who you don't actually know what sits behind them.
And you heard about them on TikTok, rather than a reputable advice
Let's not
service.
go there, Tony. I mean,
Yeah.
but marketing TikTok for excessive promotion is one thing, but TikTok for education and thought leadership is where we're going with TikTok and online media, which is what you do as well. I'm very much in your camp. One of the best things you can do for clients and for the public and people who follow us is educate them. And, I guess on our side, Tony, and we've been around a long time, and I always say you learn from experience. I mean, and what I try to do and what clients is try to share our experience, what we've learned from wrong decisions, how we got things right. We certainly talk broadly about the macro scene and try to educate people on why macro is important. I constantly read this nonsense about, macro is not important. It's absolutely important. Every day we wake up and we hear what the bond market's doing in America and what Jerome Powell's doing and what Donald Trump's saying and what tariffs are doing. If you think that doesn't have an effect on the value of assets, you're crazy.
You've been a bit of a go-to thought leader on that kind of thing. So where could listeners go to access your commentary?
Well, we're rolling out extensively on YouTube, so please follow us. We've got over 1,000 followers now, so you can tap on that, or you can come directly to Clime for our website and become a follower that way. We do weekly emails to our direct clients and followers, so which bundles everything up in 3 or 4 reports. One is a verbal, as a podcast, question and answer, and other things are written. So we do a lot of that to our clients and followers. But we are branching out through the social media network. We're a business. I mean, we do have to get our brand out there. And your first question, what does Clime stand for? Well, you've got to promote to get an audience, and then it's a big game out there. There's lots of competitors. First of all, get our brand out there and we do branding through thought leadership and education. I think that's one of the most powerful ways to promote yourself. And then people can decide whether you're talking nonsense or you're talking some sense. And we're quite happy to have debates. I mean, I very often have debates on my podcast if people put in comments or direct questions to me offline. I'm very interested in what people think. I mean, I'm still learning even at my age. I'm fascinated by other people's thoughts if they contest what I'm saying, and I think they have some basis to it. I mean, I think investing money and having a view is very much being open to other views. You don't want to be dogmatically wrong. You want to be pragmatic. You don't want to be excessively optimistic, nor do you want to be excessively negative, So I educate people to say, look, just be open, listen to what people say, and then make up your own opinion and try not to be dogmatic. and that's, I see one of the biggest issues I see with people investing is they're just dogmatic, have a dogmatic belief, and that they're right. Well, you can't always be right, can you?
No. Very good. I'm conscious of your time because I think you've got a meeting to go and talk about convertible notes pretty soon. So,
for Clime Capital. Yeah, we have a
Yep.
Clime Capital note rollover going on, which is 6.5% paid monthly, which is quite attractive. And we're resetting the Clime Capital portfolio to attract two types of investors, people who want a constant, steady yield. And I think there's a big market for that because the pension market of Australia is growing at a great rate. And then there's the accumulation market where people want a bit better growth, which will come from income off the shares and good investments if we find them. So I've got to have that meeting shortly, so to promote it. But if anyone's interested, go to the CAM website or the ASX code and you can see what we're doing there.
And there are two Climes on the ASX listed, aren't there? There's Clime Asset Management and Clime Investment Wealth, and they are different companies.
Yeah. So we've got the Clime Investment Management Group, CIW, ASX code, and CAM is the LIC. And a derivative of the LIC is CAMG, which is the convertible note I just talked about, which will be moving into a 6.5% monthly income note from 1st of September, I think. But something to watch.
Very good. Well, John, thank you for your time. I know you're busy and appreciate the chat. And I'm guessing it's going to lead to a few chats between ourselves over dinner at some stage as well to go and debate some of the points.
Exactly. I love those dinners.
Very good to have you.
Yeah. And welcome to our board, Tony. I think I think you said it earlier, but you're on our main board, and I enjoyed your input, and I think we're better for it, which is good. And I think the performance of CIW, which we report in our quarterly update, not all you, Tony, but I think you've been there as things have developed in the last 3 or 4 months. So it's been good. And there's more coming. We want to talk to you guys about value investing and launching some products to our clients. So that's something to look out for as well. We can talk about.
Terrific. Thanks very much, John.
All right.
Thanks, John.
Yep.